All right, guys, we're going to take some time today to talk about the RSI indicator. This is the Relative Strength Index. It is probably the most popular indicator used inside the TheChartGuys community. Certainly is very popular everywhere else. It's almost a staple of any trader's toolkit, but it's something that most people don't really understand the full depth of. So we're going to talk a little bit today about what the RSI is, what it isn't, and a few of the different ways that you can use it. So without further ado, let's get into this. Let's talk about the basics of the RSI. So it is very different than something like the moving average. A moving average follows the price. The RSI is a momentum oscillator indicator, which means it stays on a fixed scale. So that's why RSI tends to always be, and it always will be, between 0 and 100. It follows, in general, the price movements because of the way that the RSI is calculated, and we'll get into that in a little bit. But at its core, it's measuring the amplitude of price variations over the short-term history. So if you have a stable price and you see a big price breakout, that price breakout deviation is going to get factored into your RSI calculation, and it's going to give you the idea or the notion if something is overbought or oversold. I'm not going to get into the history of this too much, but it's developed by Wilder, expanded in almost infinite configurations by other people. There's so much behind the RSI, so much history if you're really into that, which I am, but I'm not going to spend a lot of time on it, or really any time on this video. But I encourage you to look up the history of the tools that we use. It's kind of fascinating. But let's talk about what the RSI is. It is a simple indicator, or a complex indicator, depending how you look at it, that tells you if something is overbought or it's oversold. And the easiest example that I've seen in day-to-day life, we all basically have our own RSI calculators inside our heads in our day-to-day. And how do we do it? Gas prices. So this is something that happens to almost everybody who's either had a car, been in a car, looked at a car. You probably have been aware of the variations of the price of gas. So let's pretend that we're driving around. We have a trip coming up in a few days. We know that the price of gas has been relatively stable. It's been around $1.30 a liter. And suddenly we happen upon the Husky here who's charging $1.78 per liter. There's two things that are going to happen. One, we're going to look at that and say, wow, somebody's overpaying a lot for that gas. It's about $1.30 down the street. I'm going to go back over there. You are not going to buy that because you know that you're going to be paying too much. And in theory, that price is either A, going to come back down to what everyone else is charging because no one's going to pay for it that high, or that is the real price. There's a reason that the price is up there, and all of the other prices in town are going to come up to meet that level, in which case that becomes the new normal. Now, if we're looking at this in the sense of RSI, if we see a big spike up to 178, there's going to be a huge move in the RSI. It's going to indicate that the gas prices are too high. If you're paying that level, you're going to be paying in overbought conditions, and either the RSI and the price is going to come back down to meet the mean or the average price of everyone else in town selling gas, or over time the other prices are going to come up and meet that high price, thus creating a new average. And then your gas price RSI in your head says, you know what, this is comfortable, this is normal, this is what we expect to pay. So it shows you price deviations. And in a sense, you're using RSI calculations all the time when you're shopping. It's just in our minds. So we can use the same concept towards stock prices, and we can use the RSI indicator at the same time to give us a nice numerical calculated value that we can use to trade with. So the basic working theory behind RSI is that it indicates when there are deviations or breaks of price action from what has been the normal range. If you're trading between $10 and $12 and suddenly you get a spike up to $18, that's abnormal. That's a deviation, and it's going to be reflected on your RSI by a big spike up into overbought territory. It tells you that, at least in the short term, relative strength index, relative to what we have been paying for this stock, we are now paying significantly higher. And the other key premise behind the RSI model is that deviations, such as that massive breakout, on average return to the mean being the overall average price. So if you're paying $12, suddenly you're paying $18, it's more likely that you're going to see the price drop back toward that $12 area, not necessarily directly back to 12, but it's going to be seeking out that universal average price that is somewhere between $12 and $18, and you're going to see that manifest on the RSI index. So the RSI slope the actual line that deviates to the extreme upper and lower ranges is proportional to the change in that price action trend. Again, if we are trading at $12 and we have a sudden spike to 18, your RSI is going to jump from 50 to 90 very, very quickly, almost like you are at a 90-degree turn. So that slope and that aggression can show you just how much of a significant change that deviation is. The more extreme a deviation, usually the more extreme a response to the other side. So we'll see a big spike, we'll see a big drop, and we'll see some sort of equilibrium to follow. That slope can be used to indicate that you're going to have a return to the mean. So this is what we say: we have a breakout, we have a fade, we see that on the RSI, a spike, and we see the RSI cool off. So that is a working theory. Deviations from price actions return to a mean. Now we can look at that in the form of this trend. So this is a CGC daily chart. We can see that in several instances we have high RSIs. So we have a breakout and we see that the price tends to revert back to the mean. Now I have indicated what could be the mean price, or whatever the chart is trying to get back to here. This is just an arbitrary line through the middle of most of the price action, and is simply intended to suggest that we have an overbought condition. The price tries to get back to the white line. Now we have an oversold condition. The price tries to climb back up toward the white line. Another oversold, it tends to climb back up. Another oversold, it climbs back up. And you get the idea. The price deviations that move away from the average, in general, try to return to that average price. We can use RSI to indicate extreme situations where the price has deviated significantly away from the mean, and expect that the price will return, or at least seek to return, to that mean itself. So in addition to trend deviations, we also have breakout deviations. This is sort of what we alluded to when we're talking about gas prices. If we see a big spike in price, we can expect that either the RSI will normalize over time, or we'll see the deviation return to the mean, or at least attempt to. In this case, it certainly does. We see a big green candlestick, and we see 3 days of losses to follow as the RSI cools off and returns to its mean, happily sitting just under 70, even though the price continues to climb slowly, albeit over the next week or so. So breakout deviations are useful because we can look at the amplitude of the move in the RSI. We can look at divergence, which we'll get into in a little bit. And we can also anticipate that large breakouts have an overwhelming innate desire to return back to the mean. That's one of the things that we can count on with the RSI, either normalization or the return to a mean. So how does that actually get figured out? Well, we are not going to get into the crazy math and go through each of the calculations behind the RSI. I encourage you to do so. If you're a math person, then absolutely it'll make a lot of sense for you. But for me, I'm happy just to know the basics of how it works. And for this video, that's all we're going to talk about. Essentially, each trading day has an up or down value. The average up values and the average down values are calculated. They're smooth, and there's a couple ways to do this based on what RSI indicator you're using. But essentially, we create two different averages, and the ratio of these averages becomes the relative strength. And that is then converted into something that sits on an index between 0 and 100. So relative strength becomes the relative strength index. And this is essentially what the calculation is. Again, I encourage you to go and look at that information. If you want to know the actual calculations, it's very, very valuable. Just something that I don't think we need to get into too much for this intro video. Now, the configurations of that calculation are also very important. Here are some good names to look up: Wilder, Lebeau, Brown, Cardwell, Pong. Each of these are individuals who've had significant impacts on the RSI calculations. So the standard calculation that we are going to use in this video, and that we use for TheChartGuys education and for consultation, is a 14-period calculation using 70 and 30 as a standard threshold. So what that means is, if we go back to our breakout deviations, the previous 14 candlesticks, the up and down average values of those candlesticks are incorporated into our RSI. So that is why our RSI can adapt to new prices. If we see the price jumps up to $90 and stabilizes here, after 14 periods, we will see the RSI return back to, well, if the price is completely stable, it'll go back to a perfect level of 50, where the up and down averages have a net zero gain. 14 periods, like I said, is the standard. There's going to be variations, and make sure that if your RSI doesn't match what you're seeing on someone else's, that's the first thing to check, your periods. Now, the 70-30 is your standard threshold for your RSI. If you have a higher or lower threshold, meaning you have an 80 RSI indicating overbought or you have a 20 RSI indicating oversold, those are going to filter out a lot of not necessarily false signals, but they are going to give you alerts and indicate that results are in far more extreme conditions. A 20 oversold RSI is far more oversold and far more uncommon than a 30 oversold. So also something to keep in mind as you are learning and adapting and using the RSI in your own toolkit. This is what your RSI zones look like. The vast majority of the price action that you're going to see is going to be in the neutral zone, which is between 70 and 30. Anything above 70 is generally going to be considered overbought. So that's where our high gas prices are. And that's the area we're looking at it. We're saying, no, I'm not paying that much. I can pay. Everyone else is charging $1.30. I'm not paying $1.70. Oversold to be the opposite. That would be like you're driving down the road. You see a gas station selling it for 90 cents, having some sort of fire sale, and everyone's lining up to buy it because they know it's cheap and they know that the price should bounce back to what they're used to paying. That's why we can get into oversold bounces. That's why we can know sometimes rely on RSI to show us when things are oversold and when they're sort of, I hate to say this word, a bargain. If you've been paying $12 for a stock and suddenly it's $8, and you expect that RSI's deviation will return to the mean and price will cause that to happen, then we can look for quote-unquote good deals in our oversold zone. That's what our RSI looks like, and that's the 0 to 100 index. Now we're going to get into some of the fun that we can have with RSI. So we know that a higher and lower price generally means a higher and lower RSI. That higher and lower price meaning the deviations away from the norm. Now, divergence occurs when the new prices that we are watching, our new higher highs and our higher lows, continue to climb, but the RSI doesn't continue to have higher highs on its own index. So let's go back to our chart here. If our prices are climbing higher and higher and higher, and the RSI is setting lower and lower highs, that would be divergence. So it's a strong indication that the market, which may be seeing significant gains, seeing a lot of strength, but the RSI isn't following, that can indicate that there's an imminent market turn that's going to happen. And what that can look like in the case of bearish divergence is a trend that is climbing with higher highs and higher lows, where your RSI fails to make new highs, and we result in a momentum shift. Here is an outstanding example of bearish divergence. We're looking at the Apple daily chart, and we can see that we are consistently gaining strength since December. We're hitting highs, higher highs. We continue to climb, but our RSI here hits a high, just barely hits a higher high, but now on this day, our RSI is significantly lower than it was previously. So we're seeing a divergence in the fact that the higher highs on the price chart are differing from the higher highs on the RSI chart. That divergence indicates an imminent market turn, and in this case, we see that manifest in a big drop in March. Our RSI, in fact, went all the way down to oversold conditions, deviating from the mean substantially and resulting in a pretty nice bounce situation. So that's something that we can watch for when we're trading RSI, and we are looking for bull or bear cases. If you're looking for a bear case on something that has shown consistent strength, RSI alone and the RSI divergence alone is often not enough to make a trade decision. But if you see a bearish pattern, you see a change of trend, you're expecting weekly consolidation on a daily chart, and you see bearish divergence on your RSI, that can be one of the check marks that you can add to your trading checklist before getting into a trade to give yourself a little bit more confidence. Bullish divergence, on the other hand, is basically the complete inverse of bearish divergence. In this case, we have price or trend that is dropping. We're setting lower highs and consistent lower lows. We are trending to the downside. And the divergence occurs when the RSI fails to make new lows while the price drop is making new lows. That divergence where the RSI is starting to climb and our price continues to drop is an indication of a momentum shift. Now we can see that occur here on this chart with our bullish divergence. In this case, we see consistent lower highs and lower lows, but on our RSI, we have the higher lows and higher highs that suggest that a breakout is imminent. Now we climb back up into neutral territory, we get a trend change, we overtake our EMA 12, and we see a pretty substantial breakout to the upside and an overall shift in direction. So this long-term 4-hour chart deviates, and that deviation is indicated first by RSI Bull Divergence. Another example of bullish divergence is seen here on the CGC hourly chart. In this case, we hit an hourly low, or RSI drops. We hit a higher high, then a lower low, but the RSI does not hit a lower low. In fact, it just dips below 30 and kicks off a rather substantial hourly oversold bounce. So we see another example here of lower lows on our price, but higher lows on our RSI, indicating that bull divergence is occurring. And again, is often a key component, a checkbox on a list of requirements that you're going to look for if you have a bull case on an overall bearish stock. Now, this is where we get interesting. Stacking RSIs. So we know we have multiple time frames. You can have daily, 4-hour, hourly charts, 5 minutes. Each of those has its own set of price action, and it has its own RSI calculation. Where it gets fun is when we start stacking our RSIs against key supports. So let's go, for example, we've got a daily trend. We have been trending down pretty healthily. We're hitting lower highs, lower lows. Our RSI is dipping into, let's call it 35. RSI is 35. Suddenly we get some more substantial moves to the downside. We see a 4-hour drop. We see an hourly drop. Our 15-minute time frame is seeing a lot of red, and the daily all the way down to the 5-minute time frame has oversold RSIs. And guess what? We're coming up against a key support level, either a psychological level, let's call it $20 psychological, or a moving average. And we are oversold on all time frames as we approach that key level. If we stack our RSIs, and on each of these time frames, we see a massive deviation from the mean, with the expectation that the RSI and the price wants to return to that mean, we can get a fairly substantial return on a low-risk trade in oversold conditions against a key proven support. Stacking RSIs can be an amazing toolkit, and it's probably the best bounce performance that you can expect or hope for in a strong uptrend. You have a weekly uptrend, you have daily counter trend, and everything inside that is oversold. It doesn't get much better than that. Here's an example of stacking RSIs on a Bitcoin 4-hour chart. So in each case, we can see that we've got 5, 15, 30, hourly, 2-hour, 4-hour, all oversold at the same time. That results in a pretty substantial shift and a huge bounce, and to the point where we get 5, 15, and 30-minute time frames are overbought. Things start to cool off. Bulls are not done. They push the price back up. We get overbought on everything from the 5 to the 4-hour time frame. We see a huge shift in the opposite direction. Momentum turn. We see the opposite. We're oversold in 5, 15, 30. We get a bounce. And you can see how all of these stacking RSIs can be combined together to create situations where we are simply too overextended. There's no one left to drive the price in that direction. The absence of that energy and that momentum results in an elastic springboard shift back to the other side. And this is why stacking RSIs can be very, very useful. All right, let's talk about a few of the issues that we run into with RSI. It's definitely not a perfect indicator. It can be pretty useful, as you've seen. But you know what? The RSI has its problems. First of all, it's only relative to individual price history. We can't really compare RSI to anything else. Even RSI on one ticker's individual time frame can have very different behaviors. So an hourly RSI on CGC can behave drastically different than a 5-minute RSI on the same ticker. Beyond that, we can't even compare the RSI behavior on a ticker to any other ticker in the same market or even the same sector. CGC is an MJ related name. We can't use the RSI values there directly correlated to anything else in that sector. It just doesn't apply well. Beyond that, we can run into issues with gaps inside our price. If we have a massive deviation and price tends to stay up there for a while, say after a well-founded earnings jump, that RSI is going to have limited applicability because of previous price history, in the case of using 14 periods for calculation, is not going to be as useful on the daily time frame because that old information is there and we have not yet developed 2 weeks of trading to round out a perfect new RSI that properly respects the new price action following the period of price discovery. And that is also the reason why we can't really use RSI in all-time highs or all-time low situations. If we get a stock that is very stable, that sees a huge increase in volatility, the liquidity is very low, it is climbing like crazy, and there is just a huge amount of hype and demand for it, RSI sort of gets thrown out the window. We see a huge deviation, far more substantial than anything we've seen before. We can't rely on RSI being overbought, especially when we get into a situation where RSI maintains overbought conditions for quite some time. There are instances where RSI can be plus 70, plus 80 for a week or more without having any sort of deviation or return to the mean. And that is an issue if we're trying to use our regular RSI strategies for trading in those conditions. Another issue with RSI is that it can't be interpreted algorithmically for some of the reasons I mentioned above, but because also there is a lot that goes on with RSI relative to a lot of other indicators. If we are looking for RSI, we always need to be looking at trends, we need to be looking at price action, and we need to be looking at things like our MACDs. We need to be looking at our higher lows. We need to be considering all of these different aspects together, which make RSI very subjective and make it very, very difficult to use algorithmically beyond just, is this sub 30 or is this above 70? Now, we can't really rely on those either because, as we discussed in all-time high, all-time low conditions, extreme cases can often negate the applicability of RSI. And lastly, individual tickers all have their own RSI history and key levels. RSI can, on one ticker, consistently bounce from 20, but on another, rarely ever break 30, and 30 becomes a psychological support for it. So if we are trying to apply the rules from one ticker onto the other, it doesn't always work. There's a lot of individual behavior, a lot of individual personality that goes into understanding, interpreting, and applying the information that RSI can give us. That being said, it's an incredible tool. It's very, very important for us to understand how to use RSI and when we shouldn't be using the information that it provides. But overall, I think you'll agree it is a very, very critical item to be in and part of your trading toolkit. And I hope this video was helpful for you. All right, friends, if you've been watching on YouTube, that's a wrap for the video. Thank you for following along. I appreciate your views. If you have any questions, please post them in the comments. I'll do my very best to answer all of them. And if you ever have more questions, you want to learn more about the markets, TheChartGuys.com is a place. And if you are watching on TheChartGuys.com, we're about to get into all of the different RSI strategies. So if you want to learn more about that, check out this video, the expanded version, on TheChartGuys.com inside the educational library.